Australian equities relative to other asset classes like cash, term deposits, fixed income are actually a pretty attractive place to be. The S&P 500 has also hit new highs. You've also seen four of the big tech companies, Microsoft, Alphabet, breaching $1 trillion in valuations. Where are markets now? Well, we've actually surpassed the 7,000 point level for the ASX 200 in price terms, and a lot of people in the marketplace are obviously commenting on it, and that's hence why I'm talking to you today. But in actuality, there isn't much difference really between 6,995 points and 7,030 points where we closed on Friday afternoon. So what it will actually do from a behavioural standpoint is trigger a lot of people to actually review their portfolios. And what I would caution against is actually people assessing the market as being richly valued just because we've reached a new high. Arguably what you should be doing is really looking at the long term and assessing what the characteristics are of this market and potentially how the market may perform going forward over the longer term. Well, interestingly, the S&P 500 has also hit new highs as well. So you're going to increasingly see conversations about valuation metrics. You're going to hear a lot about PE ratios and valuations potentially being stretched at these high levels. You've also seen four of the big tech companies, Microsoft, Alphabet, for example, breaching $1 trillion in valuations. So a lot of market commentators will be suggesting potentially that the markets are richly valued. But what I would suggest doing at this point in time is really having a thinking about the global macroeconomic backdrop, which a lot of investors and a lot of economists are suggesting has improved over the course of the last 6 months, particularly with central banks cutting interest rates very drastically and really stimulating the global economy. We've also had improved risk sentiment around Brexit, with Boris Johnson being elected in December in the UK. And we've also seen a truce in the trade tensions between China and the US with the signing of a Trade One phase deal. I expect continued optimism in 2020, particularly as risk aversion has started to fall given the outlook for the global economy. I think that increasingly people will be nervous, particularly given where the market levels are at. But I do think that the market continues to grind higher from here, but it won't be without risk. It won't be without volatility. So increasingly, Australian investors will have to get used to potentially 5% drawdowns on a far more frequent basis. And the reason is because interest rates are so low. With the RBA interest rates or the RBA cash rate at only 0.75% and the market factoring in potentially another rate cut by June and 50-50 in terms of a rate cut in early February, we have to really think about valuations being stretched, and as a result you see a lot more volatility in the marketplace. But Australian equities relative to other asset classes like cash, term deposits, fixed income are actually a pretty attractive place to be, particularly when you think about the yield on the market being around 4%, and then when you take in that franking element, it can be a really attractive place, particularly relative to those lower income paying asset classes. So we've seen numerous studies around this, and one point I will make is the ASX 200 breaching that 7,000 point level is also known as round number bias. So when we see these big numbers, a lot of investors increasingly will assess their portfolios because it triggers them. They see a lot of the headlines, there's a lot of economic commentary out there, but importantly, a new high suggests that something is expensive. So what we often see, and academic studies have shown, is that investors review their portfolios, they review their stock holdings, they'll frequently sell those things that have performed well and hold on to those things that have performed less well or poorly in the hope of perhaps generating better gains going forward. And what you ultimately see is investors selling high and then potentially suffering if the market continues to move higher or vice versa. So what I would suggest at this point in time is maintaining your diversification within your portfolio, but importantly maintaining that long-term outlook.